Okay, well, good afternoon, everyone, or perhaps for those on the West Coast, good morning still, I guess. My name is Gerald McMichael. I want to welcome everybody and thank you for attending this webinar on maximizing agency valuations. This webinar is brought to you by the Peer Executive Groups, which that's Dan's company, and the Best Practices Insurance Group, of which I am the chairperson. We're blessed to have the talent that we do, and Mark Parsells presenting the topic today. Mark's presentation is about a half hour long, just enough time to pique your interest and to come back for more. Also, because of the tremendous interest and attendance in the webinar, only the moderators will be visible. We also do have about a 10-minute Q&A time after Mark's presentation, so hang tight for that. You'll get a chance to answer questions or ask questions. We will certainly try to answer as many as we can, but if we run out of time, we'll make sure that we post all the answers out to your questions and push those out via email over the next day or so. So let me just first start by saying that as retail insurance agents, we have a lot of pressures on us from every side. We've got external pressures from our carriers. They're insisting on more volume. They're pushing us to lower commissions, and they're requiring us to do more of their work. So if you're like me, that doesn't feel like too good of a position to be in. But I get it. When my father started in the business in 1976, personal auto commission rates were 25% and homeowners commission rates were 30%. Oh, for the good old days. But we didn't write a lot of business back then. These situations create our own set of internal pressures, so we need to write more business to keep our carriers happy, and we'll need to become more efficient so we can reduce our operating costs. We do have a bunch of new late entrants into the insurance business. Amazon has been selling insurance in India. Tesla has been selling auto insurance to the buyers of their vehicles since 2019. And just 5 days ago, they announced they're coming after our clients. Tesla made the statement that insurance providers will have to evolve or die. The Tesla owners I know, they say that Tesla cars are more of a computer than they are a car. So if they can build cars and they can send rockets to the moon, how can we compete with them? But I think they've got the wrong question. I think the question really is, how can they compete with us? Consider Google Compare. The giant tech firm launched an online agency and they shut down in 2016 after just 1 year of their foray into the insurance business. We have a complicated business. Outsiders like Google, Amazon, and Tesla have a hard time understanding what we do. They don't realize the complexities of our business or what it takes to make money. And they also don't realize how easily those profits can vanish in a catastrophe. But I do believe Tesla is correct. We must evolve. I don't think that's the doom of our industry if we don't, but let's face it, we're way too far behind the times with technology. But what we have that Google, Amazon, and Tesla doesn't have is us, a knowledgeable insurance professional, an advocate that can structure the right coverage, that can give accurate responses to our clients' questions, that can find the best price, that can keep the clients happy, and that can help them navigate through claim process. Quite truthfully, the savvy insurance buyer understands that. We also know how to make those interpersonal connections. The relationships that we can form help us engage with mortgage brokers, title companies, real estate agencies, and other organizations that have large client databases that we can partnership with and access. If we are independent agencies and we have a multitude of insurers who know how to market, they know how to make money, and they know the risks that are involved. So we've already got the carriers aligned with us. We already have the relationships. The critical piece we need to get up to speed on is automation of our processes. Through the use of automation, we can utilize data, collect it more efficiently, and gain the size and scale we need to satisfy our carriers. We can become more efficient so that we can reduce our operating costs. And when we achieve these objectives, then we will be highly valued and much sought after insurance agencies that will turn the head of the insurance industry. We have a saying in my agency, sales cures all ills. But it's not only that, we have to operate as efficiently as possible. Or Tesla just may be right. If we can solve the issues of technology so that we can maximize our efficiency, generate more sales, then we'll reap the benefits of having more control over our schedules and create an optimal work-life balance with an agency that has real value. We have some representatives on the call today that can help you develop your automation and generate sales leads that will propel you into the future. That's what our best practices group is all about. It's pushing you ahead of the learning curve. I often joke with my peers in the group that you don't have to lose thousands of dollars making mistakes. I've already made them all. So you can learn from me and you can save a lot of money. But if you want to join the group and if you want to invent new and creative ways to lose money, that's great too. I'll save a bunch of money learning from you. So getting to the winning line quicker and doing it more cost effective is what we're about. If you're already a part of our best practices group, and thank you to those who've joined on to the call, remember that we have our semi-annual meeting on October 8th and 9th in Columbus, so make sure your calendars are marked. If you're not a part of the group, we'll be sending an application to you in the next day or so for you to complete and return. And remember that we do need to have all those applications in by mid-August so we can consider your request and complete that process so you'll be up and ready to join us for our October meeting. So with that said, at this time, let me introduce to you Dan Crowley, give you a little background on him. Dan was involved with several automotive manufacturers in the mid-90s. He served as facilitator of several of the dealer 20 groups, as well as being involved in serving in the GM Roundtable. Dan has bought or sold over 20 privately held companies and has acted in various roles as CEO, COO, CFO, and VP of sales, and any other alphabet soup you can throw in there, right, Dan? Dan's a certified family business specialist and a certified business succession planner. In 2001, Dan started Peer Executive Groups, which is what our best practices group for the insurance industry is part of. And Dan is actively managing over 20 different peer groups. So, Dan, take it away.
All right, excellent. Well, thank you so much, Gerald. That was an awesome introduction. Everyone, I want you to know that we have these, webinars about twice a week, and we are very fortunate today to have Mark Parsells with us. He's the founder and managing general partner of the financial intermediary and strategic consulting firm Montpelier Ventures, based in Wilmington, Delaware. And previously, Mark worked for CEO Sandy Weil as the president of Citigroup's #1 ranked Citibank Online and head of online banking technology globally in 52 countries with 10,000 employees. He led multi-billion-dollar business units at American Express and Bank One, including leading the Bank One insurance business, focused on Bank One's $40 million credit card customers, and Bank One was acquired by Chase, you might recall. He was also chair and CEO of 3 venture-backed financial technology businesses, fintech, backed by firms including AIG, Bain Capital, and Goldman Sachs. He raised funds and worked directly with AIG's CEO, Hank Greenberg, you might know that name, to build the first online auto insurance marketplace with 8 leading underwriters, then sold it back to AIG to enable them to cross-sell auto across the 4 P&C lines that they ended up owning via their acquisitions. In 2017, Mark was selected as one of the top 100 global executive coaches by the world-renowned executive coach author Marshall Goldsmith. And Mark is certified as both a stakeholder-centered coach as well as talent to value coach. The methodology developed by Santiago, the chief HR officer of Blackstone Group, you might be familiar with that name. Mark coaches CEOs as well as senior leaders at some of the world's leading academic institutions, and he currently serves on 3 corporate boards as well as on a variety of nonprofit boards. So with that, everyone, this is Mark Parsells.
Thank you, Dan. And the one piece I should add is that it's not just an executive coach talking to you. The primary part of my business, which I should have shared with these guys, is that I do M&A for the lower middle market. And I go across industries, but I have developed just over my 35 years of working in the financial services industry, including fintech and insurtech, kind of an expertise in that area. So we don't have a lot of time today. So what I'm going to do is I'm going to walk through 3 primary areas. I'm going to first talk about the M&A deal activity in the agent and broker space. I'll then move on to talk about how to think about valuation for brokers and agencies. And then number 3, I'll talk about the deal process. If we have any time, I'll talk a little bit about my firm. And then I'll also talk about insurtech, but that could be a different seminar that we do because there is a ton of money going into that space and kind of deserves its own time to talk about. So let's start with M&A activity. As you probably all know, the M&A activity has been kind of on a tear since 2011 when there were 291 deals, peaking in 2019 at 649. So 2019 was the strongest M&A activity year in your sector in history, slightly up from 2018 where it was 643 deals done. I'm going to talk a little more about the top buyers in a minute, but the big players are the private equity and what I call PE hybrid groups. So those are privately owned companies, but that are using private equity money. So by the end of 2019, they made up 69% of all transactions. And you'll see it's even gone higher in 2020. And not surprisingly, the number of unique buyers is now down to 131 from 177 in 2017. And the reason that's not surprising is this is a mature market and consolidation is happening. And even though there's still thousands and thousands of agencies, the bigger players who are doing the acquisitions, they're buying other companies who've already started rolling up companies. So that's why you see fewer and fewer unique buyers. And I think that number will continue to go down. So here are the top 10 buyers for the last 5 years. I have to move my picture thing there. Acrisure has been the dominant player by far for the last 5 years, doing 98 deals in 2019. And then you've got Patriot Growth, which is a brand new, newly formed company that did just 25 deals last year, and they were continuing to increase their number this year. We'll see how COVID impacts them. So in this chart, this shows you just how dominant the private equity owned and hybrid, the private companies that are backed by PE have become the dominant players. As you see over here in the fourth quarter of 2008, they made up just about 20% of the deals. there's a lot of deals happening, smaller players buying smaller players, but you see this is reflective of the attractiveness, the hard market that has emerged in the last number of years in the brokerage and agency market, that they, by the end of 2019, they were up to 70%. And we're going to see that it moved up to 75% this year. So market conditions remain strong. And through February of this year, we came into the quarter looking super strong. The deals went up significantly. Not surprisingly, the firms, they're getting the best price, have predictable cash flows. They have safeguards to mitigate downside risk and high margins that are particularly attractive to PE investors. COVID-19 has definitely dramatically slowed the number of deals that have come in. And you can see on this chart, in the first half of 2018, 300 deals were done. Last year in the first half, 328. But this year it was 288. So down 12% from 2019, 4% from 2018. But a couple more charts, you see the fall off. This is my very poor illustration, but this is first quarter 2020. And look at that dramatic drop off in the second quarter of 2020. And then I did a little more artwork here. You see in 2019, it was very strong first quarter, but it went up in 2020. And then you see second quarter 2019, this was a historic year, historic quarter, highest ever. And then you see that dramatic drop off in 2020. But deals are still getting done. Acrisure did the exact same number of deals in the first half. I think they would have done more. I think they would have been much higher than 39, but they ended up at the same number they had done it in the first half of 2019. See other players like Baldwin, Risk Partners, publicly traded, really getting active in the acquisition market. But you see it's very dominant PE and hybrid companies. So in summary, the first half of 2020, I think it's a temporary slowdown. There were just 126 transactions in Q2, and that's the lowest since the fourth quarter of 2016. So that uncertainty is, put some of the private equity guys on the sidelines. It doesn't help that we have this resurgence going on. We'll see how the third quarter ends up. I think it'll be higher than the second quarter when everything was shut down. But if we continue on this trajectory of, more and more cases, then maybe it won't be such a high quarter. And you can see right here, 75% of the deals were done by private equity hybrid players. All right, so now let's move over to how to think about valuations. So this is just the average, an average industry index. It's the top 5 or 6 publicly traded brokers. And the way private equity firms value agencies and brokers is they take the enterprise value to the EBITDA multiple. EBITDA, obviously, everybody knows is interesting. Earnings before interest, taxes, depreciation, and amortization. And that continues to be the most prevalent when assessing valuation metrics in the insurance industry. And by the way, that's EV to EBITDA of the next 12 months. So it's your 12-month pro forma of the year coming up. So the multiples were kind of, languishing around, 12 to 13.5% in 17 and 18. But because the competition was so high and so much interest was being placed on this by private money, you see that the valuations were going up very, very nicely. So that boded very well for any of you considering selling. And before I go any further, I get a lot of questions. My dad or my mom had this firm, and I bought it from them, but they always told me you have to sell. The company should be valued on commissions, and it should be a multiple of commissions. So I'm going to show you two scenarios as to why that is not how any buyer is going to value your business. So it's really obvious right here. You've got two companies that look exactly the same. So if we just said 2 times commissions, each company would be worth $2 million. So you would get 2x. But there's a huge difference. Agency A is very efficient in how they run, and they have an EBITDA of $350,000, while Agency B is a little bit bloated, and they only are generating $200,000 in EBITDA. So you can see the return on the buyer's invested capital pretty healthy with Agency A, but not even worth looking at for Agency B. So here is how they would, how private equity buyers are going to look at your agency. They're going to see the exact same numbers, but they're going to price it on EBITDA. And let's just say it's 6 times EBITDA, which is a very conservative multiple. And you see that Agency A is worth $2.1 million, while Agency B is only worth $1.2 million, or 1.2 times commission. But most importantly, from a buyer's standpoint, I'm indifferent at these prices because I still get a 6.7% return on my invested capital. And I'm happy to answer questions when we get to the end, if there's any questions about this. But then what a lot of buyers have said, or sellers have said, well, why do I care? Who cares about a buyer that, how they look at it? The way I look at it is I want 2 or 3 times commission. Well, the reason you should care is, one, you're not going to sell your business unless you find the best sucker. And if you do find that person, please send them to me. And, I have the old axiom, I have a bridge crossing from Brooklyn to Manhattan that's for sale. So 80% of businesses don't sell that are put on the market. That usually are people who try to put them up themselves, don't really understand the market. And the reason most companies don't sell is that it's an unrealistic price. So what happens is you waste tons of time trying to pitch your business, and you're trying to explain to somebody why your agency is worth more. But you can see it makes, if this is the way I look at the business, I don't care what you say. If my return on invested capital is negative, there's nothing you can tell me to buy at the price you're trying to promote to me. And as a result, you alienate those buyers. And then when you want to come back out, you realize how you should sell it. It's too late. Nobody wants to waste time on you. There's a second thing that's worth considering. And I would say, what could be worse than alienate a buyer? Well, what could be worse is you actually have an incredible EBITDA, and using the multiple of commission methodology, you'll be underestimating your firm. So by using that commission multiple, you might be leaving a lot of money on the table. So hopefully that has explained why the enterprise value to EBITDA multiple is the way you should think about the value of your business. And if your EBITDA is not where you want it to be, that would be the first thing I would start thinking about. And these are the key valuation drivers that a buyer is going to look at. And again, if you're on the buy side and you're looking at other firms to buy, this is basically what you want to be looking at. You want to look at a firm, look at its organic growth, and many firms have been doing M&A on the buy side. And so you want to look at how the mix of that growth is going. And then, of course, you want to look at the profitability. Growth is good, but it's not good if you're losing money as you grow. Client concentration, less client concentration is better. Nature of relationship, longer term relationships are better as well. Size and scale of the operations, a bigger profitable organization is going to get a higher multiple than a smaller, less profitable organization. All common sense. The mix of business, do you have multiple lines and diversity in your product mix? Do you run your business well? What are the retention ratios, loss ratios? Management, are there really key personnel and producers that a buyer is going to be very, very interested in? Are you in niche markets? A lot of buyers like niche markets because they're easier to protect once you buy them. And then technology's overtaking this industry from the standpoint of not competitors in these online marketplaces. But I agree totally, with Gerald and Dan that I don't think technology is going to put your business out of business anytime soon. Insurance is sold, and you have to have it's a person-to-person kind of thing. But you can leverage technology in a lot of different areas. And again, we're not going to have time to talk about that in any detail. But for lead generation, for managing your business efficiently, there's some incredible technology which I would be making myself aware of if you're not. And then what kind of contracts are in place, what kind of non-competes, what are your carrier contracts like? So now we said the value is based on enterprise value to EBITDA. But there's the EBITDA, and then there's adjusted EBITDA, or seller's discretionary earnings. So I'm just going to walk this through, and I hope you can all follow. So obviously for EBITDA, you have to take out the interest. So you have 1.687 EBITDA to start with. Now, on your adjusted pro forma, things you want to adjust, you want to take out the interest income. So this is going to be interest income that's related to the business as opposed to interest income on investments. So you take out that first, so that's $75,000. Then you normalize owner's compensation, because when you sell the business, you may be getting $400,000 or $500,000, but a buyer, especially a big buyer, is not going to be paying that. They're going to probably be paying half. So you add back 200 because the new buyer will not be incurring that expense. Then in terms of compensation, many people have family members or spouses that may not end up in the business. So you want to take them out of the employee compensation pool. You then want to take out whatever employees, yourself and family members, you want to take them out also, their expense out of employee benefits and payroll taxes. Then in travel and entertainment, a lot of people, are a little bit gray, and they do some private vacation and travel and automobile expense that's more private for themselves and their family. You can figure what that is, what those values are, and you add those back to EBITDA. And then finally, of course, you add back amortization, depreciation, and interest. That's how you calculate EBITDA. And you see that your EBITDA has gone up quite a bit from 1,686 to 2,184. And what does that mean to you in terms of selling? Well, if your EBITDA is almost 500,000 more, and again, using a super conservative multiple of EBITDA, at 6 times EBITDA, that's 6 times 500,000, that's $3 million. So that's why it's really, really important to adjust the EBITDA before you go out. In general, so these transaction multiples were from like mid 2019, when multiples were going crazy. Traditionally, less than 2 million has been more like, anywhere from 4 to 6, 4 to 7. It was 7 to 8 in the middle of last year, 8 to 10. If your business was 2 million to 10 million, the initial one was less than 2 million in revenue. And then if you're greater than 10 million, it was 10 to 13. And then the really large ones were going closer to 15. In terms of deal structures, they can take many forms. Sometimes they're all cash. More typically, there's some cash coming from the buyer. If it's a big publicly traded company, they may give you part cash and part equity, stock in their company. Bank financing is a major piece, and then seller promissory notes. You might take 70% in cash and give them a note for, 3 or 5 years in a promissory note. And then protective requirements for the buyer that are typical. They want employment and producer agreements for the top producers. And then they, of course, want you to non-compete. You can't walk out the door and start another agency and compete with them. Expect 99% of sales to be an asset sale. It is very, very unlikely you're going to sell your company as a stock sale. So just take whatever your LLC or your C Corp or your S Corp and sell it for a bunch of reasons. Number one, a buyer will redepreciate everything you have. And so you might have stuff 10 years old and they're going to redepreciate it starting now and depreciate it over 15 years. That's huge benefit to them. Then also they don't want any of your legal risk, any liabilities that would typically transfer upon sale. And so you would maintain your corporate existence. You may just dissolve the company, but a lot of owners also own their property. And it's rare that private equity firms want to buy your building too. So, and I won't get into these details, but you can make sure you're charging a market rent and you can get a nice annuity with the rent, and you may just have that asset in your former, corporate entity. So you're not going to give away the corporate entity. They may want to buy your name. That would be an asset that moves over, but they're not going to buy your company. In the rare cases that they do happen, does happen where they do a stock purchase, they will buy all your obligations. They just buy your legal entity. There's no benefit to them in the depreciation step up. I have never seen a stock sale in the 60 years I've been doing it in this space. Yeah, I'm not going to get into this in a big way, but it's really important if you're a C Corp. You could get double taxed. It's really important to have a great accountant. You can go to an S Corp, and without getting into the details, this is something, if you do sell the company, you need a really good accountant and a good advisor who will walk you through how to think about that. All right, so that's valuation. Quickly on the selling process. So was what my company does. We're in the intermediary. We help you first. You need 2 really important other advisors. You need great legal counsel and one that has M&A experience, and a really good accountant also who has some M&A experience or is in a firm that can bring in that experience. And most accounting firms and lawyers are part of firms that have other experts if they're not. Then the intermediary establishes a sales process, obviously in conjunction with you, putting timelines on for potential buyers. We prepare and assist with you the deal documents, which I'm going to talk about what those are in just a minute. 2:37. Okay, I just want to check my time. We identify and contact prospective buyers. We pay lots and lots of money for private market data. So we have hundreds of thousands of buyers. We have all their contact info, often their mobile phones, their email addresses. We don't waste time. We know exactly what buyers are buying and what they're not buying, so we can make the process very efficient. And remember, you're running your business, and I was a CEO/president for 35 years, and I did a lot of deals in those roles. And it is really hard to do the first 12 hours of your job, and then you've got to find your next 12 hours to work on these deals. And it's not a lot of fun. And that's why, I got to appreciate good intermediaries when I was in an operating role. Coordinate the signing of NDAs. We set up data rooms to share confidentially the key data. We run the due diligence process. We prep you for presentations because even though we give a lot of documents at the end of the day, if you or key management is going with it, the buyer's going to want to hear from you, because in general, in the investment space, you never bet the horse, you bet the jockey. So it might be the best horse in the world, but without the right team or without the right rider, investors rarely invest in those types of companies. We help you negotiate, and we help with comps. So in the process, there's a lot of preparations. I give you a gigantic list of questions, because before we go out, we don't want the deal to get sidetracked because we don't have something ready. So you have to prepare all the financial statements. I give you lots of questions about financial matters, lots of questions about technology, intellectual property, customer sales information. Obviously, we would never share the names of any of your customers, but we do want to share the concentrations, the breadth, the mix of personal and commercial, etc. We talk a lot about what the strategic fit, what kind of buyer should buy your particular agency. We need all your material contracts. We need to know about any litigation, employee or management issues, tax matters, regulatory, and need to know you have the right insurance for your business. Then, I'm sorry about the slides, not that easy to read, but basically, my firm sets up independent data rooms for each potential buyer. So we only share the data that they request or the data we want them to see. You have full historical financials. We do pro formas 3 to 5 years. The mandatory things, we do a one-page teaser. So we send that out to, a larger number of prospective buyers without identifying who you are. We'll give the general region, you're in the mid-Atlantic, you're in the Southwest, whatever. And that has the key highlights. And then if somebody's interested, we sign an NDA with them. And then we work with you, but we do most of the preparation of the book or the confidential information memorandum. And once the NDA signed, we share this book. The shortest I've ever had has been maybe 45 pages. Longest I've had is 130, 132. So these are books, and they have everything about your company, and that is a massive amount of work. Then we also help you with pitch decks and detailed longer decks when you're in the second round of diligence. Okay, real quickly, who we are. We have very deep transaction experience. I'm not going to go into much detail because if you're interested, you can reach out to me. The key is we do use private data. We spend a lot of money. I use the same database that Goldman Sachs uses, that Bain Capital uses. I just negotiated a much better price. You can see we have 243,000 investors, and we're looking at nearly 1 million deals. And so we really understand the market. And like most firms, we have a monthly retainer, exclusive, a success fee, and then normal deal-related expenses, which are pretty close to zero. All right, so we can stop there if we want. Like, here's a normal project plan, but you can't really read that too well. But in general, just get to prep you, this one is 27 weeks. It can easily, I have a deal right now that's in its, we're almost at 48 months, but we're going to sell it for a gigantic amount of money. But we're dealing with publicly traded buyers. And, so some deals can take that long, but you don't want to just sell for not the right price. You want to sell to the right buyer. Okay, that's that. And I don't think I'll let you guys jump in, Gerald or Dan. I won't go into the InsurTech just on this, other than this slide. There's agent broker portals, and this is kind of the space where you guys are, where you guys play. There's a ton of money going into this space. This shows the VC activity, 114 deals last year. And you can't see this eye chart, but this just shows gigantic amounts of money going into InsurTech in your space and the big players. So, but I'm happy to do a more detailed presentation another time. Okay, thanks. That's it.
All right, Mark, thank you. So if you're kind of doing the math in your head, and Mark's talking about 24, 30 months, as high as 48 months to actually do the deal from start to finish, that's just selling the business. You also got to get a lot of things in place before you even want to get to that point. You want to have the right people in the right seats in your agency. You want to have the right management in place. You want to make sure you have good, solid non-compete agreements that are formulated in advance of ever approaching a buyer. I mean, that can kill the deal right there, can it, Mark?
Yes, it can. You definitely have an enormous amount of prep, and that's why with my firm. So the one thing that frustrated me with investment bankers is they didn't understand how to run businesses. So all they want is you to give them all their data, and they'll slap whatever it is into a presentation, and they'll just go out and try to sell it, and they want to sell it as quickly as possible, almost like a real estate agent, and get to the next deal. And so what I often do, the reason I have strategy in there, I'll often work with a company for a year to a year and a half, just working on prepping it, working to re-engineer it so your EBITDA looks more like company A than company B, in my example. And, look at, if you have too much concentration in a particular area, or you're not leveraging technology the right way, those are areas that are really, certainly the technology, are very, very easy to fix. There's a little bit of a fear of dealing with some of this technology, but kind of like an iPad, it's gotten so user-friendly that, I really try to work with companies to embrace technology and to their benefit.
So one thing that is really great for the group is Dan has created some really good technology tools over the years to help us do quarterly automated financial benchmarking. And I think you just got your quarterlies in from 130 different businesses, right, Dan?
Correct.
So the point I'm trying to make with this is, with the technology, with putting the right people in the chairs, with building the business so you can get to the 10 million revenue mark, with putting the technology pieces in place to make sure you can maximize the value of your agency. This stuff takes time, and this stuff takes plugging in with the right organizations that can help you gauge and monitor and grow your business, get the right technology in place, get the right people in place, get the right producer agreements in place. And that's what our peer group is able to bring to the table.